In the heart of Bangkok's gleaming financial district, a quiet but momentous battle is unfolding, one that could reshape Thailand's economic future and determine whether the Bank of Thailand can maintain its independence in the face of mounting political pressure. The selection of Thailand's next central bank governor has become far more a routine appointment. Finance Minister Pichai Chunhavajira faces a defining choice between two finalists, Vitai Ratanakorn, the government savings bank, and Dr Roong Mallikamas, the BOT's deputy governor. The decision will determine not just who sets interest rate, but whether Thailand's central bank can preserve its role as an independent guardian of monetary stability. This struggle isn't unique to Thailand. According to Kristalina Georgieva, managing director of International Monetary Fund, or IMF, central banks worldwide face growing threats to their independence, particularly mounting pressure for premature interest rate cuts. IMF research is clear: central banks with higher independence scores consistently outperform in controlling inflation and maintaining price stability. As Georgieva emphasized, independence is critically important and represents a superior tool. Successful countries value this principle. The tensions began immediately after the Pheu Thai party returned to power in 2023. Prime Minister Sethar Thavisin championed ambitious stimulus measures, including a 500 billion baht digital wallet scheme. But the BOT under Governor Sethaput Suthiwat repeatedly raised concerns about fiscal discipline. The friction reached a crescendo when Pheu Thai leader Pathongthan Shinawatra publicly criticized the BOT's independence, calling it an obstacle to economic recovery, triggering fierce backlash from economists and former central bank officials. The government's attempted appointment of former Finance Minister Vitai Ratanakorn as BOT board chairman provoked unprecedented opposition. Over 800 economists and 4 former governors signed petitions in protest, viewing the nomination as a part of a broader strategy to subordinate the central bank to political objectives. Though the Council of State eventually blocked the nomination, the episode exposed the depth of institutional conflict. The two finalists represent starkly different approaches. Vitai Ratanakorn embodies the government's preference for closer fiscal monetary coordination, advocating aggressive interest rate cuts and enhanced policy alignment. His supporters praise his pragmatic, populist approach to immediate economic needs. Dr Roong Mallikamas offers continuity, a career central banker with an MIT doctorate who emphasizes preserving BOT independence while improving government communication. She advocates maintaining the bank's core mandate of long-term stability through financial system modernization. Current Governor Sethaput recently offered pointed advice to his successor, warning that given the current context, credit ratings are crucial matters that must be carefully considered, as we are now in a situation where the storm is coming. Stability is therefore paramount. Despite shifting the BOT stance from neutral to accommodative, the policy rates at 1.75% to support the economy. Sethaput emphasized that even accommodation requires careful consideration of long-term stability. The stakes extend far beyond Thailand's borders. The country's central bank has long been viewed as a model of institutional independence in Southeast Asia. Any perceived erosion could significantly impact investor confidence and financial stability. From Turkey to Argentina, political leaders have increasingly sought to influence monetary policy, often with destabilizing consequences. Thailand's choice will signal whether it maintains institutional strength or joins countries that have compromised their monetary independence. Finance Minister Pichai has made his expectations clear, stating that the new BOT governor should have a broad vision and forward-looking perspective to navigate modern financial challenges. His emphasis on the need for fresh leadership reflects the government's desire for closer coordination between fiscal and monetary policy. But this decision represents more than just personnel selection. It's a fundamental choice about Thailand's economic governance. The appointment will test whether democratic institutions can maintain independence under political pressure and whether sound economic principles can survive electoral politics. In an era of unprecedented global pressure on monetary authorities, Thailand's decision will determine whether it preserves the institutional foundations that have underpinned its economic development or sacrifices them for short-term political gains.